All right, this is always one of my favorite panels talking about capital markets, and we have two great practitioners with us today to help guide this conversation. And the topic is liquidity versus fundamentals, the endless tug of war between speculation and investing. And highly topical, all the conversations about private credit and everything else. This is just, I think, going to be a fascinating conversation. So joining us is Rich Bernstein. He's got a new title, Global Head of Macro Investing and Custom Strategies at Janus Henderson Investors. And that's a new firm for Rich. He recently was acquired. He sold his firm to Janus Henderson. He joined the firm just this year, following Henderson's acquisition of RBA, Richard Bernstein Advisors. He leads a global team dedicated to investment models, ETF construction, and customized macro solutions. He ran RBA since 2009, was both the CEO and the CIO. He oversaw their investment committee, managed their multi-asset global equity and fixed income ETF strategies. Importantly, he had RBA Insights, which is a newsletter with 25,000 subscribers. I'm assuming they paid for that advice, they get it for free, okay. Is it still going?
It's still going.
Still going, so you can still get it. He's a frequent guest on CNBC on Bloomberg. You were on CNBC yesterday. I think I saw you on there. And regularly quoted in Barron's, the Financial Times, Wall Street Journal, etc. Before RBA, he was with Merrill Lynch from 1988. And some names from the past, if some of you remember, E.F. Hutton and Chase Econometrics. He's a trustee of Hamilton College and currently sits on the Hamilton College Endowment Investment Committee and was formerly the chair of the Alfred P. Sloan Foundation Endowment Investment Committee right here in Boston. Received his BA in economics from Hamilton and an MBA in finance from NYU, and 45 years of industry experience. So thank you, Rich, for joining us. And many of you know Marc. I have known Marc for a long time. We kind of started out in this business a long time ago. His title is the CIO Non-Traditional Strategies, and he's a managing director in the Newport Beach office of PIMCO. He is a generalist portfolio manager and a member of their investment committee. He rejoined PIMCO in November 2014 after serving as the head of fixed income at GMO here in Boston. And previously, he was a PIMCO MD, and he also worked at Harvard Management Company. And before that, another name from the past, Standish Mellon Asset Management, and a portfolio at Fidelity Management and Research, whereas I think we first met many, many years ago. 38 years of experience, and importantly, holds his undergraduate degree from Boston College. So, over to you.
Thank you. Thanks, Dan. It's funny, every once in a while you sit here and you wonder, well, I wonder a few things. I got a bone to pick with Andy before we get into the discussion. You got your lunch. You apparently were hungry because you mentioned lunch twice.
I'm never hungry. I never don't eat enough to be hungry.
Every once in a while, you sit in these moments, you realize you got to do some real work on your bio or something, because after following Nick Burns and Professor Romer and Rich up here, you listen to their bios, you're like, man, I got to start making some stuff up because I sound like a real piker, you know. Now, you'd think if I put my name on this thing, you'd let me have the morning off, and I could just sit here and relax and listen to some smart people. But you make me work. You're literally going to make me work for my lunch. I am.
You're in.
That's good. That's good. That's good. It's funny. Dan mentioned, Rich, that you sold RBA to Janus, and we sort of figured it out fortuitously. We had a call last week, just checking in, and I sort of thought, well, I better look up. I'll look up Rich, and I'll see some of his current writings and thinkings, and just have a sense of his views on the world and macro and markets, and as most of us do, we look folks up on Bloomberg, and it pops up, and it says, Richard Bernstein, Janus Henderson. I thought, well, there must be something wrong. And so we checked in. We talked about it a little bit. But congratulations on
Thank you.
on selling your eponymous firm to Janus. And I actually thought it was pretty fascinating. So maybe we'll get you to start just, and it's far from liquidity versus fundamentals, the endless tug of war between speculation and investing. We'll get there, but liquidity versus fundamentals, the endless tug of war of having an independent advisory firm versus selling to a large asset management firm.
Right.
What'd you learn through that process, or any insights?
So it's, well, first of all, Andy, thank you for inviting me. And I want to assure everybody that, much like Paul, I will be getting a haircut at the end of the semester, too. So, you can't tell, but this is really out of control.
You know, it's funny. I almost started by asking you whether you were jealous of Paul's hair, and I thought you might take offense to that. So I kind of thought I'd rein that one back.
I haven't had hair like that since I was about 18. But that's okay. But no, look, I think anytime you go through an M&A transaction, I think it really brings you back to business school, right? You start learning about valuation again. You start learning about projections and pro forma analysis and things like that. And you learn some things that you don't learn in business school about how to sway pro forma analyses and either make them more aggressive or make them more conservative. And that's really what an M&A transaction comes down to, is that fight over should it be more conservative or more aggressive, and what does it mean to the valuation and everything else. So it was, obviously, to everybody at RBA, it was a very important transaction, but it also brought us all back to business school, which was kind of cool.
That's great. And tell us about your new role at Janus. I mean, what changes for you?
So what changes for me is going from being a 30-person firm to going to a 2,000-person firm. That's obviously a big change. But on a more serious note, I don't think people really understand what's going on in the asset management industry and how it's getting harder for small firms to compete. I use the analogy that if you walk into a supermarket, Wegmans or whatever you go into, Piggly Wiggly, I don't know where everybody's from, but if you go into the soda aisle, you'll see lots of Coke and Pepsi. You see that, and if you want RC Cola, it's there, but it's down in the bottom corner, and that's because Coke and Pepsi pay for shelf space, and they've been doing that forever, and there's nothing wrong with it. But I don't think what financial advisors understand is that that's now going on big time in the asset management industry. And so, whether it's BlackRock, Blackstone, PIMCO, or
We don't buy things.
yeah, and but you know all the names.
We don't buy things because you just benefited from it. You tend to overpay. So you
Exactly. So there's all these, and so we call them the hippos, and the hippos are in the water. And the unfortunate reality is the financial advisors think that the reason that they're seeing Blackstone, BlackRock, KKR, Apollo, all these firms, is because that their firm thinks it's important for them to see it. And they don't realize that, much like Coke and Pepsi, those firms are paying for shelf space. Just as the same way as you walk into a supermarket, you see Coke and Pepsi, your natural reaction is, I'm going to go get Coke and Pepsi. To the financial advisor, it's the exact same thing. And so naturally they think, oh, wow, that's what everybody's doing. I want that too. And so it makes it very hard for a niche firm to compete now because we're kind of the RC Cola down on the bottom. So one of the huge advantages for us now is that we've always punched above our weight in terms of our media exposure and everything else, but now we have a balance sheet behind us. And so Ali Dabaj, who is the CEO of Janus Henderson, when I gave this analogy one time, he said, well, we're not Coke and Pepsi, but we're Dr. Pepper. And most people don't realize that Dr. Pepper now sells more soda in the United States than Pepsi, which is actually true, by the way. I checked. It is actually true. And so for us, it gets us this media exposure, but now we have a pocketbook behind us, which is really good. And for Janus Henderson, what they get is they get a macro point of view. They're known for being stock pickers, both the Janus side and the Henderson side. And so now we have kind of a macro view, and we can meld those two together. And I think it's a very powerful combination. And you'll notice I'm wearing my Janus Henderson pin, just to show I've been completely indoctrinated. I've got the tattoo underneath, but I thought it'd be a little strange to show that part. But
now, for a $10,000 donation to the business school, Rich will give you his Janus Henderson pin.
Exactly.
Don't all jump up at once and take that opportunity.
We meet later Where's Andrew, a donation? Hamilton, you've done enough, now it's time for Boston College.
I knew there was an ulterior motive.
You're not going anywhere until.
All right, let's get on to the subject at hand. Well, you mentioned Janus now gets a macro view, and you're well known for pretty well thought out, pretty well sought after, and usually pretty accurate macro perspectives. Paul asked me a question at breakfast this morning and said, something I'll summarize is like, I don't know how you guys do it. I mean, you bond investors, you got to think 30 years out, and how can you even, it's hard to understand what's going on today, tomorrow, the next day. So curious on it'd be interesting to hear your macro views. Maybe I'll compare and contrast with some of our views and just talk a bit about how you think about time horizon.
Yeah, it's one of the most difficult things, I would argue, in investing is you may see something happening, but when is it actually going to happen, I think complicates matters pretty dramatically. And especially in an era right now where everybody wants everything to outperform by the next commercial break on CNBC. I mean, that's legitimately where we are. People's time horizons, I've never seen people's time horizons shorter than they are right now. And from our perspective, that leaves tremendous opportunities if one is patient. The problem is trying to convince your investors to be patient. It's a very tough tug of war right now involved there. So just in terms of what we're seeing, we don't actually make formal forecasts. It's kind of weird for a macro firm, but rather what we do is we treat everything as kind of an over-under bet, since Kalshi is so popular these days. Let's talk about over-under bets. And all our portfolios are structured to whether things will be stronger or weaker, better or worse than everybody thinks. It's, so people say, well, what's your forecast for inflation? And they get very upset when I say, well, we don't have one. Everybody wants 3.2% or something. The decimal point is very important. And we just say we think it's going to be higher than people think. That is what our portfolios are structured for right now. We do think that inflation will just be higher than people think. If consensus is 3 and it turns out to be 3.5, we win. That's all. We don't worry about whether it's 3.25% or something like that. So we think inflation is going to be higher than people think. We think nominal growth will be higher than people think. We don't see any reason to take long duration risk in the fixed income market until we start getting signs of the next recession. We think the Fed's going to have a very tough time cutting rates. That'll be interesting. That'll be a lot of fun, I think, over the next year. We think it's going to be very hard for the Fed to cut rates. And we think the opportunity set for investing is probably the biggest in my career, in the equity investing, probably the biggest in my career. I think that when people are talking about 7 stocks and ignoring the fact that there are growth stories all over the United States economy and all over the world, I can't believe that people think that 7 stocks are the place to be, and they're ignoring everything else that's going on. And so I think that opportunity set is monstrous. It's a question of whether people have the patience to wait for that.
Yeah, we might come back to this in a second, but I had a pretty interesting dinner earlier this week with an investment banker who spends a lot of time in boardrooms and made the comment that he's never seen boards of American companies more bullish on doing things.
Yeah.
More axed to do things.
Absolutely.
And his basic, maybe we could talk about this now, and we'll get back to some of the views. His basic viewpoint was bigger is better, right? The technology spend, the supply chain questions, concerns, disruptions, the need for greater certainty comes with scale and size. That the political environment couldn't be better for M&A. I mean, there's almost there's no restriction,
Right.
Except for maybe United American Airlines, but we'll see. And that if we don't do it, somebody else will.
Yep.
And that probably builds around some of your view that there's 493 great stories. Well, there might be a few pretty lousy stories, but
Yeah.
493 other stories out there.
Yeah.
Does that sound right?
Yeah. I think we publish a set of charts pretty regularly. By the way, if you want that newsletter, all you have to do is go to rbadvisors.com and sign up. You have to give us your email address, and we'll start learning all about what you do from that. It's kind of creepy what goes on, but that's okay. one of the charts that we publish pretty regularly, and we just updated it internally, we haven't published it yet, is we look at earnings growth by company, and we show you a chart, just like a bar for each company. And we highlight where the Magnificent Seven companies are in that chart, and you would be shocked at how average, I would say, the Magnificent Seven companies are in terms of their earnings growth. And then if you look at free cash flow growth, because they're now changing their balance sheets pretty dramatically, you look at free cash flow growth, they look pretty paltry. I mean, there's so many other things, so many other companies growing in the United States and growing around the world, both on an earnings and a cash flow basis. I just don't get why people talk about the Magnificent Seven. It doesn't make any sense.
Well, we'll get back to, because I think it's funny, you and I have slightly different macro views. Maybe we'll debate it a little bit, and then, but it ends up having a pretty similar portfolio construction, which is which is sort of interesting. That you can come at the world with different perspectives, and maybe that speaks to the robustness of the opportunity set, right? I mean, you can have different views, but maybe the views don't matter, right?
To some extent, you're 100% right.
I do tell this anecdote, and this will sound very Bond geekish, which is what I am, which is probably why my bio kind of sucks. But
it doesn't. It doesn't.
I had the misfortune of having a work trip planned to Australia and leaving the night after the Liberation Day announcements. And so, here we were in April whatever, 6th or whatever it was last year. And so I basically am watching the Rose Garden press conference and, trying to read the tablets of who was getting what tariff and watching markets and incredible amount of maybe in the Rumsfeld framework, unknowable unknowns, because this really was new territory. And then, for those who've been to Australia, and for those that have flown Qantas, it's the one airline in the world that doesn't have internet. And so you sort of leave with this, sort of this tornado in the middle of this volatility tornado, and you get on a plane for 14 hours with no access. So it's either sheer bliss or sheer terror, and about every 5 minutes I went from sheer bliss to sheer terror. Anyway, I'm making this a long story, and there's more important things to say. I got down to Australia, and I went straight to the office. I turned on my Bloomberg, and the price of a 10-year note future, which will mean nothing to most people in this room, was $111.11. $111.11.30. That's the way they quote it. And I thought, wow, that's an interesting number. Do you know what 10-year Treasury note future is today? 111.8. So for everything that's happened in the world, and maybe this is why portfolios, we can have different views about the world, but maybe some of it doesn't matter because we're going through these crazy news flow cycles, and lo and behold, equity market keeps marching higher. Bonds are earning their yield, which is pretty substantial these days. Cash rates continue to fall, and the opportunity set for alpha generation within dispersion and a global opportunity set seems pretty profound.
Yeah, it is. It is. So it's interesting. You mentioned the news flow and everything. I wrote a book 26 years ago, which is like embarrassing, but 26 years ago, that was called "Navigate the Noise." Get the subtitle: Investing in the New Age of Media and Hype. That was written, I think, in 26 years ago, 25 or 26 years ago, and it's more appropriate today than it was back then. It's incredible, and the point and the beauty of like being shut off for 14 hours is it was kind of the point of this book that building wealth, especially as an individual, building wealth is not difficult. It really isn't difficult. So why don't people do it? Right? That was and if you're into Greek mythology, the argument was that there's always a siren song of something newer, better, sexier, whatever you want, and everybody goes running and goes and does that, and then of course, to continue the analogy, they crash on the rocks, and that's what the book was all about. And I think being shut off for 14 hours, it forced you to be disciplined.
Well, I mean, I say this to folks all the time. I run a portfolio, and it is flexible fixed income portfolio. It is AA- average credit quality, so a high quality portfolio doesn't need a lot of private credit, doesn't need a lot of junk, doesn't need a lot of low quality stuff, and maybe we should talk about private credit because it is interesting, but it doesn't need it. It's got 3.5 or 4 years of duration, so it's basically a 3 or it's a 3 or 4 year average life, average maturity portfolio. So you're not taking a bunch of interest rate risk, and it's got 7% yield.
Yeah.
I mean, when that's your starting point, our lives are actually pretty easy.
That's okay.
Or most. I mean, to grow wealth, you can
Yeah.
if that's a starting point of an asset allocation, it's a pretty decent starting point.
It's crazy, right? Yeah.
Why do you worry about inflation? Why do you think inflation is going
Why
to be
are
higher
we
than
worried
people
about
expect?
inflation? So there's a secular and a cyclical reason why we're concerned about inflation. First is, let's talk about the secular. We just don't believe as a firm that the reason we had secular disinflation, that 25-year, 30-year period, whatever, was because of the great stewardship of the U.S. economy. We don't think it's attributable to Fed. It's certainly not attributable to sound fiscal prudence, that's for sure. And so the question is, what is it? And we would argue it was globalization. And then what globalization did, very simply, was just open markets and increase competition. And with all due respect, you don't need a PhD to know that when you increase competition, you get downward pressure on prices. We constantly opened market, constantly got more competition. We put downward pressure on prices. We now call that secular disinflation. And so about a decade ago, we began to suggest that globalization had expanded as much as it was going to expand, and that through time it was now going to start contracting. And as it started to contract, your mindset should change from secular disinflation to secular inflation, because we were going to reduce competition, and as you reduce competition, you get upward pressure on prices. Now, we didn't say that was going to happen in an hour, or again, remember the CNBC mindset, it's got to happen by the next commercial break, but we thought this was a secular phenomenon, and I think that's been right. I think we nailed that globalization has started to contract, and you see that there's lots of symptoms, wars being one of the symptoms of contracting globalization, and sure enough, there's wars. I'm not going to say we got all the terminology right. We didn't talk about tariffs. We talked about customs and duties. We didn't talk about supply chain disruptions, but we talked about the risks of disaggregated production, something like that. I can't remember exactly. It was a fancy term that we used. And so we kind of got that theme right. And I think that's still ongoing. I think deglobalization's in full speed now, and I think competition is being reduced, both for goods and for labor, by the way. I mean, we could argue, by the way, I'm not judging whether these policies are good or bad. Don't misunderstand the point. That's not my day job, is to opine on politics. It's just the reality of what's going on. And we're constricting the flow of goods. We're constricting the flow of labor. Seems to us that with a monstrous trade deficit, how could it not be inflationary, right? If you don't make anything and you're dependent on the rest of the world for everything, how can deglobalization not contribute to inflation? So that's kind of our secular backdrop. Cyclically, we just think that, think of what I just said, but think of it in like a shorter time frame. Wars are kind of inherently inflationary. We are seeing supply chain disruption cyclically. There's all kinds of things going on that are making us believe that. And we actually think that this is not the 1970s. I think it's really cute to say, oh, oil prices are up, it's the 1970s. But oil prices as a percent of wages is still very, very low. And that actually argues that oil prices could go up a lot more. I mean, if you're an energy fan, that's music to your ears, that we're not close to demand destruction yet. And you've seen that in some of the data that has come out recently where people are surprised that the consumer is still consuming. Well, yeah, because oil prices are up. And by the way, pardon my language, oil prices going up is pissing people off. That is happening. That is happening, right? You see it in consumer confidence, you see it in these things, but they're not changing behavior. And I think that's the key thing. We don't care whether they're angry or not. It's a question of whether they're changing behavior. And so far, they don't seem to be changing behavior. You've got all that going on, and the economy itself is still reasonably healthy. So we're getting kind of these supply chain disruptions, everything else, with I think a healthier economy than people think, and that kind of translates to upward prices. And we may have a Fed that's going to be accommodative. So you put all this together and you say, what's going on the fiscal side? Well, we view this as being very 1960s-like, the guns and butter period of the 1960s. Now, if you're not familiar, the guns and butter period was basically 65 to 70, take or leave a little bit on that, where the guns part was the build-up to the Vietnam War. The butter part was the Great Society, Lyndon Johnson's Great Society. And the consensus basically was that you could increase spending on both of those. You could have an accommodative Fed. It would do nothing to the budget deficit and would do nothing to inflation expectations. Obviously, hindsight's 20/20, but that wasn't quite right. And so what are we getting today? Well, we're getting a huge defense buildup. You know, where the Defense Department just submitted the first over $1 trillion budget, $1.5 trillion, I think is what they've asked for. We're not getting the spending side the way we did in the 60s. In fact, ironically, some of those programs are being cut back. Right? Again, not my day job to point if that's right or wrong. That's just the reality of what's happening. But we are getting the one big beautiful bill. Now, the president, occasionally prone to hyperbolic speech, will say that this is the biggest tax cut in history. It's not. It actually, by our reckoning, it looks to be like the sixth biggest, but it's still monstrous. Still monstrous. So you've got the guns going, you've got butter, but it's tax cuts, not spending, but it's supposed to be stimulative to the economy. You may have an accommodative Fed. I mean, we'll see. That's kind of an interesting point. But it kind of seems to us like that's going on. And if you look at a lot of the employment statistics and things like that, it actually looks like the 1960s. So
it's interesting. I mean, that there's no doubt that from the question on inflation, there's no doubt that there is a round of deglobalization going on that is probably quite secular in nature. I mean, it will be interesting to see what the global perception of America is once this is resolved. I mean, Nick sort of touched on it, but we've been quite negative on the dollar, partly because of that. We worry less about inflation. That again, I think the three legs of disinflation, globalization was an important one, but also demographics and an aging economy, which tends to demand less stuff over time. And technological disruption. And I mean, this is what seems to be going on now is technological disruption on steroids. And whether or not it leads to, I mean, it will likely lead to some meaningful improvements in productivity that we're already seeing. It will likely lead to a healthy degree of job insecurity, which we're potentially already seeing in a no hire, no fire economy that could pivot to a fire economy pretty quickly. And that's us, again, I mean, inflation higher than, the decades preceding COVID, but maybe not as high as some might fear. So I'd probably take the under if you were to take the over, whatever consensus might be.
Well, let me. I don't want everybody leaving here saying that Rich thinks that inflation is going to be like 6, 7, 8% or something. That's no. The way to think about it is the Fed. I don't understand it. It's still, I understand politically, but I don't understand economically. They're still using a 2% inflation target. And I would argue that's either tremendously antiquated or they've got a boatload of inflation fighting to do, and they're not doing it, right? So they kind of have a choice here. Either like give up the 2%. So I would argue instead of 2%, maybe they should be using 3 to 3.5. I mean, if you want to get excited and you want to like really blow a gasket, say 4. But I think that's probably a little extreme. But I think they should be using 3 to 3.5 instead of 2.
Let's touch on growth for a second, because it's a phrase that I used to like a lot, the K-shaped economy, because it used to be quite novel and creative. Now everybody uses it, so it's time to figure out something else. Right. Haven't been thoughtful enough or creative enough to think of what something else is yet. But again, for those, the K-shaped economy is if you're in the upper arc of the K, meaning large cap companies, wealthy individuals, you have this, you've got remarkable tailwinds from investment, from wealth, from generally accommodative policy. If you're in the bottom arc of the K, meaning small and medium-sized enterprises or lower income wage earners, there are some real challenges. I mean, you probably know the stats as well as I mean, if you look at delinquencies for the bottom 2 quintiles of wage earners on autos, cards, student loans, they're spiking to a similar extent that we saw in the global financial crisis.
Right.
And for those that are following events in turmoil, let's say in private credit markets, I mean, there's a real fundamental shift downward in credit quality for small and medium-sized enterprises. In fact, the statistic I shared with John earlier, 11.6% of American companies under $250 million of EBITDA don't have cash on hand to pay their interest expense.
That's right.
They're paying in kind. They're kicking the can down the road and just saying, I won't, I mean, it was wimpy. I'd gladly pay you Tuesday for a hamburger today. Like, the debt is always, I'd gladly pay you Tuesday for your money today, but even half of those companies, that's 1 in 8 American companies, half of those companies didn't have PIK language in their indenture.
Right.
So there do seem to be some real bifurcation, which, by the way, you and I probably agree is opportunity for investors,
Yep.
but real challenges in terms of the differentiation between winners and losers in this economy.
Absolutely. I have to tell you, my wife and I don't want to give you the wrong impression, but my wife and I have a house in the Hamptons. And the Hamptons is
one of those guys. Okay.
Yeah, exactly. But the Hamptons is a fascinating economic experiment. You can watch, like, it's a laboratory, if you will, an economic laboratory, because you can watch some of these things happen. And so one of the things that I've noticed is that virtually everything in the Hamptons has become an inelastic good. And people are just starting to realize that no matter what you want to charge, people will swallow it. And so you see this in the menus at restaurants.
See, you should start charging for the newsletter.
I should start charging. Yeah. But exactly, give it away for free. But you see it in the menus of restaurants. But my favorite one is you see it in the gap between premium and unleaded gasoline. It's really cool because, not me, we do not have this kind of car. If you got a Maserati or you got a Bentley, you're not putting regular in it, right? And so what's happening is the gap, I look at it relative to the national average. National average is like $1, I think, right now, which is amazingly wide. In the Hamptons, it's well over $1 between premium and regular. And that's pretty cool. I mean, from an economic point of view, if you just think about the laboratory and you can watch what's going on, you can see this happening. It's really, really cool. And it reflects what you were saying about this K-shape. Any number of goods has become perfectly inelastic to the high end of that K, right? And if certain parts of the Hamptons, if you've ever been there, you got the 1% of the 1% of the 1%. Nothing matters. There is no price that they will stop purchasing. It's really fascinating to see it. And at the other end, all you have to do is go a couple of towns inland and you find a whole different situation, completely different situation, which is really pretty wild.
That's interesting. So we would worry again. We would worry that the economic statistics that we all see and read about are. I mean, it's the establishment survey for non-farm pay. It's established, right? And so it may not be capturing the small economy to the extent that we should or probably need to, given some of these dynamics. Because the question ultimately is, will the top arc of the K drag the bottom arc up?
Yeah.
Or will the bottom arc drag it down? And I think that it's an open debate. It's an open question. I mean, it's probably large. And by the way, to go back to the original, it might not matter, right? Because when we go to, pick bonds, pick stocks.
People don't tend to think about shorter duration equities, though. And people don't tend to think about shorter duration equities, though. And people don't tend to think about shorter duration equities, though. And our people don't tend to think about shorter duration equities, though. And our portfolio. People don't tend to think about shorter duration equities, though. And our portfolios. People don't tend to think about shorter duration equities, though. And our portfolios right now. People don't tend to think about shorter duration equities, though. And our portfolios right now. People don't tend to think about shorter duration equities, though. And our portfolios right now tend to think about shorter duration equities, though. And our portfolios right now tend to think about shorter duration equities, though. And our portfolios right now are geared to think about shorter duration equities, though. And our portfolios right now are geared towards shorter duration equities. What are shorter duration equities? Dividends. Just like if you think about the way I've described it, I used to teach in the grad school at NYU, and one of the ways I used to describe it was think of a PE ratio. Think about no growth. Assume a company has no growth at all. the PE ratio tells you how many years of earnings get you to today's price, right? So if it's PE 30, you've got 30 years of earnings that you have to get to today's price. If it's PE 5, it's 5 years of earnings. And then the question is, do you have some interim payment? Because remember, what duration measures is not only how much return you get, but when you get it, right? And so a PE of 5 with a dividend yield of 5 gets you a very short duration investment versus a PE of 30 with no dividend at all, right? So what are we focusing on? We're focusing on lower PE, higher yielding companies, because the history says that's what works when inflation starts going up. And you might say, why? Why does that work? Well, it works because as inflation goes up, people need more near-term cash flow to meet their costs and meet their obligations and to reinvest at still higher rates of return to keep up with inflation. What do I mean by that? Perfect example. Think of what I would argue is a giant tsunami heading for colleges and universities right now, right? What have colleges and universities done? They've all gone to the endowment model, which works great in a disinflationary environment. In an inflationary environment, it does not work. And why doesn't it work? Well, because you put all your money into alternatives. They were spinning off all this cash because interest rates were going down, valuation multiples were expanding, and all their alternative managers could have exits and return cash like crazy. So the irony is, when you actually didn't need the cash, they were spinning off tons of cash. Okay, now what's happening? Well, inflation's going up, multiples are coming down, exits are harder, and guess what's happening at colleges and universities? Their cost structure is going up, right? Labor costs are going up, healthcare costs are going up, energy costs are going up, and they really can't raise tuition, right? If you think about the political environment, everything's going, it's very hard to raise tuition right now and pass on those costs to your consumers being students, right? And so what do they really need? They need a lot of cash now to meet those rising costs. How is their portfolio endowment invested? Long duration assets that have, I'm going to get a little technical here, they have negative convexity. They're getting a longer duration as interest rates are going up. That is an ultimate nightmare for college and university, and they're all looking at it right now. And so you go to them and you say, well, why don't you just buy dividend-paying stocks? No CIO, and I sit on my own college's endowment committee, so our own CIO at Hamilton has heard me say this many times. You can't pay a CEO a couple $1 million a year to buy dividend-paying stocks. And so they won't do it. They won't do it. It's an amazing thing to see from the outside. And so there's this asset liability mismatch. So we're trying to get in front of that. We think that if you agree and you think that there's more inflation, people are going to need income. They're going to need income. And they're going to need it today. And so that's shorter duration investment. So our fixed income portfolio is all over short duration fixed income, high quality fixed income. And our equity portfolio is very focused on dividends. And then the second part, I realize the war kind of throws a monkey wrench into this, non-US stocks. Non-US stocks, I realize they've been cheap forever and a day, not enough for us. But we are actually seeing now as growth rates outside the US and growth rates in the US, earnings growth rates are starting to converge. They haven't converged past tense, but they're starting to converge. So you're getting accelerating earnings, you've got a dividend yield, you've got cheaper valuation, and here's the best part. Non-US stocks comprise 35 to 40% of the global equity market. My former colleagues at Merrill Lynch regularly publish what's going on in their private client system. Non-US stocks comprise 6% of equity portfolios in the Merrill Lynch system right now. 6%. So let's assume they go to 12%. They double their positions. They'd still be massively underweight. But think about what that would do if that happens at Merrill Lynch and Morgan Stanley and UBS and Ameriprise. And think about that even in terms of colleges and universities and foundations. And everybody's very, very underweight non-US. So it doesn't have to be that they go overweight US. All they have to do is have like more. And I think we win.
It's interesting, again, I mean, we talk about actually slightly and in some instances, or on some topics, pretty meaningful differences on sort of the macro outlook.
Right.
But would wholeheartedly endorse your portfolio. I mean, we would definitely think that the yield curve should be quite a bit steeper, right?
Yeah.
I mean, the great thing about owning a 2-year bond is anchored to a Federal Reserve, and I'll use his words, not my own. He in fact said it in his Senate testimony. I mean, Kevin Warsh said, I will not be Trump's sock puppet.
Yeah,
Effectively.
right.
I think that's the phrase he used, but he clearly is coming in with a mandate to keep interest rates lower than otherwise would be the case. Mm-hmm. And so, if you own a 2-year or 3-year maturity, you're anchored to a central bank that is likely to keep interest rates lower rather than higher. The problem with a 30-year bond is you're unanchored by a complete lack of debt and fiscal lack of fiscal discipline in Washington. I mean, nothing would make me happier than to see Paul Ryan run for Congress again, and bring the Tea Party back. But that's not going to happen. As we say, the great thing about a 2-year bond is in 2 years you get your money back, and you can decide it could be a good investment or bad investment, but you get your money back at par. The problem with a 30-year bond is in 2 years, guess what? You got to wait 28 more years.
Right.
And I probably won't be around in 28 more years to get my money back when it matures. And so would completely agree, and then would say the same about global diversification, right? I mean, if you can buy equities at a discount, why not?
Yeah,
and in bonds, Andy must be getting hungry. It's time to go to Q&A. But if we've got terrible debt and deficit dynamics in the United States, and I can buy Australian government bonds where they've got a balanced budget and half of the debt stock that we have as a percentage of GDP, and get another 0.75% yield, why wouldn't you want to do that? Yeah. Same with emerging markets. I mean, Peru has bonds that yield 6.5%. They've got 1.5% inflation. They don't have an inflation problem, but they've got an attractive real yield. And so you build in this globally diversified portfolio, both in fixed income and in equity, and it's
makes a lot of sense.
Built around value. It makes a ton of sense.
Yeah.
Even though we have different views on inflation and growth.
We've got about a little under 10 minutes for questions. I think I just read the headline. We just crossed over 100% debt to GDP.
Yeah.
It's finally crossed over yesterday or something
right.
like that. So it's very, very, very disturbing. Questions from the audience for 83 years of experience in macro portfolios. Not to age you guys.
83 years. Yeah,
Wait a minute, I'm almost 60, so that only makes you 23 years old?
Yeah.
Oh, wait, industry experience. Okay.
Industry
I was
experience.
gonna say.
All right, in the back. Please wait for the mic.
Thank you. Can you talk about, with both political parties kind of seeking, simply because President Trump wants low interest rates, that doesn't mean the other side also doesn't want low interest rates. And so maybe there's this weird asymmetry where rates really aren't lowered as much, but yet in the background, are a lot of forces that suppress rates. Can you talk about what some of those other forces might be that we don't see so visibly, but actually might even have more of an impact?
So I'll start off. I would just say, I don't think there has ever been a politician in the United States who has wanted higher interest rates, with maybe one exception, and that might have been Jimmy Carter, maybe. And he suffered for that pretty dramatically. Even though appointing Paul Volcker turned out to be the right thing, he suffered for it pretty dramatically. So I think everybody's learned from Jimmy Carter's experience that you never ask for higher interest rates. And so I don't think what's going on right now is necessarily hugely different. Certainly it's louder than it has been in the past, but I'm not sure it's hugely different. Many a Fed chair has had a very tough time with the White House. This will probably be tougher. I don't know why he wants that job, to be honest with you. I think it's rock and a hard place type stuff. He's either going to, be remembered as being the name, the 1960s, 1970s, Arthur Miller.
Arthur Miller.
Arthur Miller. Or Arthur Burns.
Burns.
Not Arthur Miller. I'm getting Arthur Miller's.
Well, it was
the
a little bit
playwright.
Arthur. It was a little Arthur Miller.
Yeah. Or he becomes the piñata for the White House, right? I mean, I'm not sure which is better, but I don't know. Do you?
No, I sort of agree with that. I mean, I again, my bias is that, and Kevin Warsh has spoken about this, right? There is an AI productivity enhancing, revolution, if you will, that is going to allow for lower interest rates rather than higher interest rates, and that's his base case, right?
It is.
That similar to Greenspan, that the productivity enhancements are going to allow for sustainability of lower interest rates than perhaps many are expecting. He's inheriting an incredibly divided Board of Governors.
Oh my God.
I mean, the dissents this week, 4 dissents, 1 to lower interest rates, 4 to removing what seemed to be, accommodative language. That's the highest number of dissents since 1972. So bringing back to that era. So a very divided Fed. There's also a lot of other things that the government will try to do to bring interest rates down. I mean, the president has suggested a 10% cap on credit cards. That does a lot to bring interest rates down to the average voter. The administration instructed the housing agencies, Fannie Mae and Freddie Mac, to buy $200 billion worth of mortgages. Guess what? $200 billion of demand. You know what that does? It brings the rate down and the spread down. So there are actions like that. And then the Treasury can do an awful lot in moving issuance around that could bring interest rates lower by flooding the market with more bills. So there's a lot of levers that could be pulled on the interest rate front.
Other questions? One more in the back.
You began, thank you for your insights and comments. You began by talking about the asset management space. So maybe you could comment on that again, if you would. My question is, do you see the boutique asset management space consolidated in a similar way to the medical profession, where the independent doctors now become part of larger groups? And maybe comment on whether or not the boutique asset management firm or that concierge doctor scenario will continue to exist in the asset management space.
I think there's always been a role for aggregators in virtually every industry, right? I mean, certainly asset management, there's been aggregators. Wealth management, there's been aggregators for quite some time. I think the supermarket was really an aggregator. If you think back to the history from all the little mom and pops and where that, I think it was, the guy's name was Cullen. If you're from the Long Island area, you might be familiar with King Cullen. King Cullen was actually the first supermarket aggregator who actually started doing this. So I think there's always a role for aggregators, and I think it's always kind of been the story in asset management. It kind of ebbs and flows, but there's tons of asset management companies that just don't exist anymore. They've been swallowed up by somebody else. I think what's unusual now is there's almost, to use what Marc was saying before, there's almost a K-shaped economy within asset management. Mm-hmm. And you've got these giant behemoths, as I said, we call them hippos, and it's becoming very difficult to just get shelf space. I mean, it's not like you can't get on platforms, but it's the visibility and the marketing and everything else. And there's a kind of a symbiotic relationship starting to go on, whether that's healthy or not for me to decide, but between the big asset management firms and the big platforms. That's definitely going on. But I think aggregation occurs in many industries. Regional banking would be another one where there's always some aggregation going on. It doesn't stop people from forming banks. But
Other questions?
So can I add one thing to what we were just talking about before? There was this notion that you walked up and you mentioned about debt to GDP being over 100%. And I find that people very often ask me the question, when is the day of reckoning? When is that coming? And I don't think, I find that question very confusing, because it's like, I'm smart and I see this, but the markets don't. That's kind of weird, right, if you think about it. Like, are the markets really that stupid that they don't? We all know this. Like, are the markets that stupid? Well, no, I would argue the markets are not that stupid. And if you look at, say, 10-year treasuries, which are now not AAA rated, versus AAA rated sovereigns, you will find that when we got downgraded, a spread started occurring. And we have actually, this is not like a day of reckoning, it's much more like a slow, insidious bleed on our economy. And we have been penalized. At one point, it got up to almost 300 basis points versus German bunds, right? Whereas through history, we kind of traded back and forth and back and forth and back and forth. Sometimes we were higher, sometimes they were higher. Since we got downgraded in 2011, we've consistently paid a higher rate of interest on our government debt than Germany has. And you say, well, so what? Well, think about everything's priced off the 10-year. Mortgages, corporates, everything. So insidiously, our economy has been penalized for our lack of fiscal responsibility. And that's been ongoing. And it's just, we don't see it. It's like watching paint dry. So I don't think it's like we're going to wake up tomorrow and we become Botswana. I think it's just this slow deterioration in our economy, and we become less and less competitive through time. And I think that's what's actually happening. I don't think it's like we're going to wake up one day and be Botswana.
Yeah, the only thing I would say, that I don't know if it's a slow deterioration of our economy because there is still a dynamism. It's certainly a potential deterioration in our standard of living.
Absolutely.
Vis-a-vis the rest of the world,
Yep.
which would suggest three things, right? Global stocks, global bonds,
Absolutely.
and global. The best way to protect yourself
Yeah.
against, a deterioration of standard of living is to own a basket of global currencies. Because
exactly.
if we want to travel, the most critical, the worst possible thing outside of jet fuel spiking in the month of February, the worst possible thing is the dollar devalues.
Yeah.
And dollar doesn't have to lose reserve currency status for it to go down 10 or 20%.
Right.
And 10 or 20% makes summer in Italy or cherry blossom in Tokyo or Christmas in Sydney a lot more expensive.
Yeah, think about the irony. The people talk about the Mag 7, but they talk about how we're doomed, that we're going to end up being Botswana, but they won't hold anything outside the United States.
Right.
That doesn't make any sense.
Well, thank you. Let's have a round of applause for Mark and Richard.